Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're here after an extended hiatus, and that's mainly due to the U.S. government shutdown, which historically is the longest that we have on record that the government has been shut down. And as a consequence of that, many of the agencies that compile data on the economy were also shut down. And without a lot of this data that's pointing to what's happening with the economic growth, with unemployment, the labor market, with prices and inflation, we all have, as market participants, are going to have a hard time forecasting and making sense of Fed policy, what it's doing right now, and the glide path of rates as they are presumably going to continue their cutting cycle. Whether that's advised or not, we tend to disagree with the course of action. However, we're going to get into that here in a little bit. Let's look at all of the missing data points. So we're missing still September real estate market information. We have some October information, personal income and spending coming out. More information from September and October. The PCE core price index, this one here, is what the Fed uses to gauge what inflation expectations are. That's coming in here sometime between today and the end of the month. We don't know. Without this data, presumably the Fed has more granular access to data where they're polling businesses directly to get a feel for what this number may or may not be. But the actual report is one of the key data points that market participants use to gauge what is happening in the inflation world, and that is the preferred gauge according to the Federal Reserve. Now, when we look at what the prior rate was, 2.8%, we'll talk about that in just a minute, but you get my point. That's high. That's not 2%, which is sustainable in long-term growth. Later this week, on Wednesday, we're getting the rate decision where it's widely expected to be another quarter point cut, and importantly, we're going to get a dot plot. In other words, where the members of the Federal Open Market Committee collectively see interest rates being, the Fed rate being, over several periods: current year, next year, 2 years, and 3 years, and then over the long run. We get labor market information that's relatively current. This is relatively current. Going forward, we're not going to have this optics problem in terms of what the labor market and inflation are doing, but certainly investors have been, in many ways, flying blind over the past couple of months. And let's talk about that. What were the last published things? So the quarter-on-quarter annualized growth rate of GDP that the last report for Q2 was 3.8%. Now, flashing back to undergrad economics, it was taught that 2% is the long-term sustainable growth rate for a developed world country like the United States economy. And we're almost double that. Is that suggestive of economic weakness that would justify cutting interest rates? Nah, not really. In fact, not at all. So unless some data comes out that says there was a marked decay in this, it doesn't appear that current Fed policy glide path of cutting rates here in a couple days and potentially again early in the new year makes much sense. And when we look at unemployment, we get another data print that suggests the same thing. Unemployment as of the last read, and this was as of September 30th, 4.3%. Okay, back to undergrad economics class. Unemployment rate of 5% was considered to be the long-term sustainable full employment rate in the economy. In other words, if unemployment is lower than 5%, you have, a strong economy and potentially inflationary pressure. If you have higher rates than 5%, you have a potentially contracting economy, issues in the labor market. But this 4.3% inflation, looking back over a chart of what this number has been all the way back to the 1940s, we are undoubtedly in rarely low territory with respect to the unemployment rate. Is that suggestive that we need to have another rate cut? Really, not so much, not at all. Here's the core personal consumption expenditure report that the Fed uses to gauge inflation, and it came in at 2.8%. And again, we're in decidedly high area, well, middle of the ground, when you consider, the 1970s and 80s, which was a highly inflationary period, which we've recently seen echoes of. And this, while being lower than it was before, is still high relative to what almost everybody that's in the market right now remembers as a market professional. You'd have to go all the way back to the late 80s to find rates, comparably high. So is that suggesting that inflation's low? No. And here's what happens. When the Federal Reserve lowers the overnight rate, inflation expectations over the long term tend to go up, because when the cost of money goes down, it essentially becomes cheaper for corporations to finance new projects. They hire more people. Those people are spending money. It pushes prices up. There's a whole circle of events that occurs with this at just the lever of the lower overnight rate, because many companies are funding themselves in those overnight markets. And when we look at what the Fed is doing, from a perspective of how their members think of things, as of the last vote, 10 for the rate cut, 2 against, and that's more dissent than is typical in one of these decisions. We're going to be interested to see if more and more of the Fed governors are coming out and saying, hey, we don't like this idea of cutting rates, we're not for it. That's something to watch, although with the Fed chairman about to be ending his term and a new one coming in that's presumably going to be dovish or inclined to keep interest rates artificially low, we potentially could see this thing continue in the way that it's been continuing. Looking at the interest rate probability, so this is a fun screen. This looks very busy and confusing. It's really not. What we do is this screen takes the interest rate, overnight interest rate futures, the Fed funds rate futures, and options, and participants, collectively with market activity dictate these numbers, and from that you can get an idea what the probability is and magnitude of a rate hike or a rate cut. And looking at this for 12/10, which is 2 days from now on Wednesday, the positioning in the market that big bond investors and the futures traders have looked at that are hedging for these activities, this suggests a 99.6% chance of a rate cut in a couple days, and that's going to be about 25 basis points, which is the widely held expectation for the path. So, we're going to go on record and say we really don't think this is an appropriate way for monetary policy to be conducted right now. But to be fair, we're lacking a lot of data that might suggest otherwise. We prefer to make our decisions based on data, not what we're being told by Washington or by what we're being told by other officials, potentially at the Federal Reserve. We want to see what the data points look like, and so far, the optics don't look appropriate for the current glide path of Fed policy. S&P 500, what are the market implications of everything that's been going on? Well, as you can see, this is a quarterly bar. We're up near the top. We're right there kissing all-time highs. And, if we want to go back more granular, let's go back a little more granular than that. Things have started consolidating in a very tight range. And the average true range, which is the difference between the highs and lows of each day on the index, in this case over a 5-day period, has come down dramatically from about 150 points to under 50 points. So that suggests that fears that were kind of prevalent in the market through the end of November are no longer prevalent. The tech sell-off has somewhat been reversed, if not just halted. And the market is trickling up. Although it's notable to realize that technology has not been as large a share of the leadership over the past few sessions, and it may be that a sector rotation could be on the horizon. If and when that happens, it would suggest us moving into a more late cycle in the marketplace. But we'll be watching for that. Does this matter over the long term? Not so much. Over the long term, the market has just done its thing and trickled up. Sure, periods of volatility happen, but we want to maintain a long-term disciplined approach to equity exposure. We don't want to be selling panics here because we're scared. We don't want to be buying things out of hand that are not part of our plan already, just because the market's going up and it has to keep going up, in our opinion. It's going to do what it's going to do, but if we're taking a disciplined long-term approach to achieve our financial goals, we stick to our plan, and we're likely to succeed in that. Interest rates. Here's where things are interesting. Pardon the pun. We have targeted 9/17 of 25, so September 17th, which was the day that we resumed a rate cutting cycle from the Federal Reserve here in the U.S. And predictably, the short maturities of the bond curve have come down because that is the only real lever here. Presumably, the thinking is if the Federal Reserve is lowering rates, that's because inflation is less of a problem. Inflation being the main pricing component of treasuries is, if that expectation is coming down at any one of these points on the yield curve, the yield is going to go down commensurately. And as you can see, it's about the magnitude, slightly less than the magnitude of the published rate cuts. But there's an interesting phenomenon, as you notice here. As we get out to 2 years, there's an inflection point. This dotted line is where the rates were as of 9/17. This solid line is where the rates are today. And in looking at this, after that 2-year inflection point, you can see that actually the current yield is higher at each point on the curve going out further than that. And the reason for that is, again, the component of inflation expectations. And this tells us that the bond investors, who are some of the most sophisticated investors in the marketplace, again, they're looking at this and saying, hey, if we're going to loan the federal government money for 10 years, we expect inflation to go up, so we need to be rewarded for that risk commensurately. And you can see that at 20 and 30 years, we're up 10 basis points. 10 years, we're up 6 basis points, 8 at 7 years. So this is saying that, despite rate cuts twice now, the yields on the longer end of the curve are higher. And that's what's called steepening. This actually suggests a healthy economy. Again, not really supportive of a rate cutting cycle at this point to continue. When we go into the corporate yield curve, corporate bonds for fixed income investors, these are actually pretty attractive yields. I'm sure everybody can recall back about 5 years ago, interest rates were near zero. Now you're getting close to 5% or even above 5% on the long end of the curve, certainly above 4% through most of it. So this is good for 2 reasons. One, the fixed income investors who are just living on the income from a bond portfolio and don't want equity risk. And 2, those who are hedging equity risk by owning bonds alongside stocks in a portfolio. The traditional 60-40 portfolio, which some analysts have said erroneously is quote-unquote dead. We don't think so. If the goal is to beat the market per se, potentially that's not an ideal portfolio in the first place. But if the goal is to achieve your financial goals and your life goals with finance, with a minimum of risk, then it absolutely still makes sense. And that's part of the whole discipline plan we're talking about, to keep it through the long haul. Reduce the risk through owning bonds, have exposure to growth from owning stocks in a blend, keep the risk low, stick to the plan when things are scary, stick to the plan when things are all full of life and energy and exuberance, and just do what was intended to do to achieve those goals. And if you have questions about your portfolio, if you have questions about the market, questions about the economy, we love to chat about that stuff. Please feel free to reach out to us. Hope you found the video useful. Thanks and have a great day.